Real estate investment practice problem using Excel. Multiple loans calculation. Get ready because we're raising the stakes with real estate. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note we have 3 tabs on down below: example, practice, and blank. Let's take a look at them now, starting with the example tab, in essence being an answer key. Scenario being that we want a $500,000 loan amount to be financing in our scenario. We're going to do that with 3 different loans that have different terms, different rates. First one, $100,000 loan, 30-year, 360 payments, rate 6%. Second loan, $200,000, 20-year, 240 payments, 6.5%. Third loan, also $200,000, 10-year on the term, 7%. So the question then is, of course, how can I compare options when I have like a 1 loan option possibly versus a 3 loan versus a 2 loan, a second and a third type of option? How can I compare those types of things? And of course, we'll be using our IRR type of calculation. One way to do this is to break that down into the cash flows and figure what the internal rate of return would be over that time frame. So that's what we'll be considering here. So let's go on to the second tab, the practice tab. This will give you some pre-formatted cells that are in blue, so you can work through the practice problem with a little bit less formatting. And then the third tab, the blank tab, is where we're going to be doing the formatting as we go from this little piece that we're starting with. So we're going to be starting out, we want a $500,000 basically loan, and we're going to start to construct this. So if we had our standard loan set up for the first loan, we're just going to copy it over so we can get our information. This would probably be the easiest way to kind of construct your Excel worksheet if you had like a standard amortization table set up. So we got the 100,000. I put that in the home. I'm not putting anything down because we're just really focused on the loan amount. So we're kind of starting just at the loan amount here. 30-year loan for the first 100,000. Then we're going to have those 2 other loans for the 200,000 that we're going to add. We got the 360 payments, 30 times 12. The rate's going to be the 6% payment calculation. Let's go ahead and calculate it over again just to practice that. Standard payment calculation. PMT shift 9, rate 6%. That's the yearly rate. So we're going to divide it by 12 to get the monthly rate, comma, number of periods is going to be 30 years times 12, or picking up the 360 periods, comma, we got the present value. That's going to be the loan amount. And there we have our payment. Going to flip the sign to make it a positive, double clicking on that amount going before the P, put in a negative there, flipping the sign to that $599.55. If we make our amortization table from that amount, then we've got the payments, which will be calculated here, rounded, pennies being excluded at the 600, interest being calculated using that 6%. If we fully amortize this and go all the way down to the end of the 30 years, it should be at 0 loan balance at that point because it will have been fully paid off by then. So that's going to be our first one. So now I'm just going to copy this over, and then we're going to be adding the next item. So I'm going to go from A to I, Control C, copying it, put it right in K, and then we're going to say Control V, and let's do it again. This time we're going to say the second loan, $200,000 on the loan. I'm going to put it right in the home amount, even though it's not really the home amount up here. I'm just really want to populate the loan amount. And so then we got the 30-year, but no, this one's going to be 20 years. So we got a different term. Well, that makes things complicated. 20 years times 12, we're going to say, would give us the number of periods because it's still being paid monthly. That'd be 240 periods. The rate now is not going to be 6%, but 6.5%. That then recalculates our payment down below automatically if we've got this populated properly, which I do. I think you should as well if you've been following along properly. But the amortization table to the right will need some slight adjustments. We're going to have to say these absolute referenced cells, this one for example, I need to be pointing to this cell. So I'm going to delete the payment. I'm going to be pointing here. Now you could make this a little bit easier. Let me show you one other method that could make this a little bit easier to copy it when you're doing these multiple scenarios. What if instead of using an absolute reference here, I just say enter, and then the cell below it, I'm going to say equals the one above it. And that way there's no absolute references. So when I copy it over, this cell will be pulling over from the relative cell reference if I copy this whole thing over, which we will to the third one. And this second one will always represent the one above it, no absolute reference. And therefore, I can just double click that down. Gets the same end result, a little bit less time if I was to copy these loans over. Can't do that so much with the interest, however, because I need to copy the interest down in this kind of more complex formula. So I'm gonna have to use an absolute reference on this one. And it just is what it is. So we're gonna say that this is gonna be equal to the 6.5% F4 on the keyboard, $ before the L and 5, and enter. Putting our cursor back on it, double clicking on the fill handle, taking that on down. Now it should be amortized after 20 years, and we have our tables built out to be 30 years. So you could go down, and in this scenario, it might be easier to delete the stuff underneath. In other words, it's going down to 0 at the end of 20. I could leave it like that, not a big deal. But when I pick up my Irr calculations, it might be a little bit easier for me to copy down the formula if I don't have these negative numbers down below. So I'm going to trim up the table. Now, you could do this a couple different ways. We have seen in the past where we can use a formula, an if, a logic function, so that when it goes to negative here, it just puts a 0. And that would be one way to do this so that you can then, it doesn't mess up the next calculation we'll do with the Irr calculation. That's one method you can do. Or you could just say, okay, I'm just going to trim this up. Or you could just leave those negative numbers, but you'll have to be careful once you do the cash flow calculations, which we'll talk about shortly. So I'm going to delete this all the way down. We don't need this because this is not going 30 years. This isn't a 30-year loan. This is a loan that stopped after 20. So we're going to delete that. I'm going to remove the rows, getting rid of the rows there. There we have it. And so these last numbers are referencing the last year. They always went like one whole place down divided by 12 and rounded. So this last one we just shore up by saying equal the one above it for the last year down here. So we don't get rid of those reference things because those reference things don't look right. That doesn't look professional, and we're professionals around here. All right, so let's do it again. Now we got one more loan, the last one being the 10-year. So I'm going to do the same thing, copying this over, putting our cursor on. Let's go from column J, like the skinny column. So I get that first skinny column, J to S, J all the way to S. And then Control C or copy. Going to put that in column T because that's going to turn into that skinny column. Paste it right there. There we have it. There we have it. What is it? I don't know, but we have it. And so we're going to have, this one's also going to be $200,000 loan to get us up to that 500. We got the 200, the 200, and the 100. So we're going to put that amount there. But the years, this time we're going to say 10 years for this one. 10 times 12 would be 120 payments. The rate we're saying is going to go up to 7%. And our payment should calculate automatically if we got it populated properly. No absolute references messing us up there. So that's doing what it should, which is good. It's doing what it should, which is good. And then the payment now is picking up automatically because we removed the absolute reference. So we fixed that problem, and we don't have to fix it because we have this other one, which is just going to the one above it. So no absolute reference on the payment. All we need to change is the interest rate then, which does have an absolute reference, which is wrong because we don't want it referring to column L, but rather column V. So V7, F4 on the keyboard, $V, $7, enter, putting our cursor back on it, double clicking Phil's handle. There we have it. So let's scroll on down. This one's going to stop after 10 years, and then it will end. So we got that same kind of thing. It's going to go to 0 there, and then it goes negative after that. We basically want to delete the negative, or you can, again, use those cells. I mean, the if functions to make them 0 when they go negative. But I'm just going to delete these ones. That's kind of the easy way to do it. So we'll go down here and delete it. Notice using the if functions is nice to do. However, if you have multiple different scenarios, because then you can have, multiple columns, and those zeros and negative numbers or whatever won't mess you up. But we're going to say table, we're going to get rid of those rows. There it is. And then we'll clean up this last part by just saying this equals the 10 above it. copying that down. So those are all in column 10 or year 10. Okay, so now we can say, okay, well, what is the rate? What is like the actual kind of rate if I was to try to combine all these things together? And for that, we're going to be using the IRR calculation. So we'll say IRR, we're just going to figure up the cash flow, looking into the cash flow, which is a little funny because one loan is longer than the other loan is longer than the other loan. So we're going to go font group. Let's make this black and white here. And we'll center it. Let's center it and then wrap the text. Can make this one a little smaller. And then we'll bring this down. We're going to say from 0, 1, 2, bringing that on down to 360 for the total of the largest loan. So we're going to have payments all the way down to the 360, 30 times 12, in other words. That's how we get to that calculation of 360. That's where it comes from. So 360, centering that, center. And then we're going to say the first amount we got is the sum of all the loans we got. So we could say we got this money, and of course we used it to buy the home, but we can imagine the loan, them giving us the money, and then we spent it on the home. So we're going to say the 100,000, the loan amount, let's pick it up down here, the 200,000 from there plus the 200,000. There's our 500,000 that we got. That's kind of like the inflow that we got from the bank that we spent on the home. Then we got the outflows that are going to happen for 30 years, but the first one's going to happen for the full 30 years. The second one's going to happen only for, the 20 years or whatever, I think it was, and the last one for 10 years. So we got to make sure that we adjust the tables. So we're going to say the first one was then negative of this payment, the 600, minus negative of this payment, minus the 1491 minus this payment, and enter. So we got those payments. Now I'm going to copy that down. It's going to pick up those same 3 cells, and because I deleted the columns underneath, hopefully it'll calculate basically properly and when we get past the 10 years and the 20 years. So let's double click on it here and see what happens. So once we get past the 10 year, that's 10 years is down here. I can look at this for the years. Look in 10 years. So it ended at 10. And then it's given me some funny value thing because it's pulling this from a table. And that's why it's still giving me a value calculation. So let's see if we can take a look at this. We need to basically remove the first one. So I'm going to say this is going to be negative. I'm going to go all the way to the left of this one. The 600 still there, and this one is still there. And then that's it. Then it stops there. So I'm going to double click on that one, take it down, because this last loan only has 10 years. And then we're bringing that down. We should end up with another value thing down here causing us a problem. So 240 is after 20 years. So I'm going to fix this one. This one only has now payments for that last 10 years from the one loan, which would be over here. This is going to be the 600. Copying that down. And there's our cash flow. There's our funny cash flow from these 3 funny loans that have different rates and different terms. And now that we have our cash flow, we can do our IRR calculation. So we could total it up. We could say, what's the total flow? What's the tote? Equals the sum of this whole column of stuff. Summing that up. And then we could take the IRR equals the IRR, the rate at which this series of flows of cash would be 0. Closing that up. This would be the monthly amount, the monthly IRR, number group, percent defined, adding some decimals. Let's make it a yearly amount, double clicking on it, going to the end of it, multiplying times 12. We got the 6.48. So that's the number we can use, kind of like an effective type of rate, or the kind of like an APR type of rate, trying to combine the 3 loans together. Now, obviously, if you were to do this for some other time period other than the full 30 years, you might end up with a different number because you're talking about 3 different loans, but you're wanting to look at the cash flow. So if you have the same scenario and you're saying, well, I'm going to stop it after 15 years, then of course you just do your cash flow for 15 years, which would look something like this. I'll just copy this on over. Copy, let's do it this way. I'll copy the skinny cell so it's the same width of skinniness. And then we're going to say cash flow, let's say 15 years. And then the inflow, this is going to be the same. And then these, I'm just going to say this equals this number all the way down. And then we'll stop it after 15 years. 15 is times 12 is 180 payments. So we're going on down to 180 on the payments down here. Right there. So those are the payments. I'm going to delete everything under this because we're stopping after 15. So we'll delete everything below the stopping point, which is all this stuff. That's no good. We're not doing that. We're stopping before that before that stuff happens. Then we're going to shift it up. And then this last one, we gotta pay off the loan balances, whatever loan balances are left. So minus we got that flow that we got minus the loan balances that would still be left, which for this long one was 71.49 minus this one over here, which still has a balance of 76.211. And then enter. So that would be the last outflow. Then the total flow equals the SUM of these items. The sum of this stuff. And there we have it. We'll close it. And then there we go. And then we can take the IRR, the rate at which this series of cash flows would be 0. The and we're going to say there it is. Making that into a percent number group, percentifying, adding some decimals. That would be the monthly amount. Double clicking on it, going to the end of it, times 12. That would give us then our yearly amount. So similar kind of concept, of course, when we're doing these different comparisons with different loans and multiple loans, we can break it basically down into like a cash flow and try to value the cash flow and figure out the rate at which the cash flow would be 0 using the internal rate of return calculation. Let's put some underlines here. Do some underlining for formatting's sake. And then we're going to go up top and we'll make this blue and bordered. That's what we do. That's what we do with this stuff, because that's where we're going to do the data input right there. And then we'll do this one blue and bordered as well. Blue with the borders. Blue with the borders on down. Like so. Like so. Like so. And then we'll put an underline right there. So there we have it. So now it's been formatted. That's the general idea.